Ladies and gentlemen, you're highly welcome to the Decalo Consulting YouTube channel. This session will be looking at financial statement analysis, and basically we have studied more about the income statement, the statement of financial position, as well as the statement of cash flow. And normally, from the financial analyst point of view, you'll be trying to analyze the income statement as well as the statement of financial position and the cash flow statement. In this session, let us focus by looking at some of the ratios which are actually performed at the level of the income statement in order to assess whether the company is performing well with regards to its peers or within the industry, or whether the company is performing well over a given period of time. Basically, we're going to understand that there are two types of performance analysis of income statement analysis that can be performed through ratio analysis. Now, at the level of ratio analysis, we're trying to look at the movements in the various ratios. We're trying to look at the movement of ratios over a given period of time or over a set of periods, and comparing that maybe to the industry standards. Let's see. First of all, we're going to realize that there are two ways in which income statement analysis can be carried out. First of all, income statement analysis can be carried out through the horizontal method or through the vertical method. Now, let's focus on trying to look at the income statement analysis from the vertical point of view. And now, basically, we're going to look at what we call performance ratios. At the level of income statement, we're going to focus on analyzing the various income statement ratios which can be performed at the end of the day to assess and see whether the company is performing well over a given period of time. Now, we're going to look at the first ratio. The first ratio at the level of the income statement, what we call the gross profit margin. The gross profit margin is simply where you try to divide the value of the gross profit by the revenue of a particular company, and then you multiply by 100. The higher the gross profit margin, the more the company is, the better it is for the performance of the company, because it simply entails that the company has a higher margin which can be used in covering of other expenses as well as fixed expenses. Now, the gross profit margin, you'll be dividing your gross profit by the sales revenue and multiplying by 100% to ascertain the value or the percentage that the gross profit actually bears on the total sales revenue of the company. The second income statement ratio is what we call the operating profit margin, or what we call the earning before interest and tax margin, which is simply obtained by dividing the operating profit or the earning before interest and tax by the value of the sales revenue, and then you multiply by 100. The third ratio that we'll be looking at here is what we call the net profit margin. At the level of the net profit margin, you'll be dividing the net profit of the company by the sales revenue and multiplying by 100. Now, this is the essential performance ratios which are actually used in assessing the performance of a particular company. Now, we equally have what we call the interest cover ratio. At the level of the interest cover ratio, we will be taking the operating profit before interest and dividing by the value of the interest expense for that period. The higher the amount